Hello everyone, this is Viraj Taral from GMT Academy and welcome to first part of our corporate action series. So today we will dive into world of corporate actions, exploring what they are, why they matter and the key type that you need to know as a future finance professional. Whether you are a finance student, an investor or a professional in this field, understanding corporate action is vital. So this event like mergers, stock splits, dividends and buybacks not only affects the individual companies but have a ripple effect across the entire market. Let's start with the basic. What exactly are corporate actions? So in simple term, corporate actions are event initiated by publicly traded company that affects its securities and shareholders. So these events typically need to be approved by company's board of directors. So these actions can have a significant impact on the value of a company and its stock. So corporate actions can also indicate company's financial health and its prospects in the near term. Example of a corporate action includes dividend, stock splits, mergers and acquisition, right issues and share buybacks. So understanding this event is crucial for anyone working in finance, investment banking and asset management. Now that we know what corporate actions are, let's discuss why they are important. So corporate action can impact shareholders' value. So corporate actions directly or indirectly affects the shareholders' value. So positive actions like paying dividends, buying back shares or merging with other companies, so that often increase the value. On the other hand side, poor management or issuing new shares can reduce the shareholders value. For example, company declares a cash dividend, shareholders receive a direct return on their investment. So if company like XYZ corporation announce 5 rupees share per dividend, it can attract more investors and they are looking for income generating stock, so that will increase the stock price. On the other hand side, if company reduces or eliminates its dividend, it can signal the financial trouble leading to decline in the share price. Next is influence investment strategy. So corporate action significantly influence investment strategies as they directly impact a company's financial health, stock price and future growth prospect. So investors need to adjust their strategy based on nature of the company's nature of these actions such as mergers, dividend, stock split or buyback. Now let's look at one example. Suppose ABC Limited announces a stock split that increases its shares from 1 million to 2 million and splitting the price from 100 rupees to 50. So this action may attract retail investors who find the lower price more accessible. So investor may adjust their strategies by buying more shares in the anticipation of a future price. So increase due to perceived affordability. Next is regulatory compliance. So corporate actions have a significant impact on the regulatory compliance, particularly in the industries like investment banking, fund management and public company. So in essence, corporate actions are not just administrative tasks, so they play a essential role in the overall investment landscape. Example, when company initiates a right issue, it must adhere to regulatory guidelines to ensure transparency and fairness. So failure to comply with this regulation can lead to legal issues and damage the company's reputation. So let's take a closer look at some key types of corporate actions. So corporate actions are generally classified into two ways, voluntary and non-voluntary. So voluntary corporate actions require response or choice from the shareholders. Voluntary actions incur more risk as compared to non-voluntary. Now what is a non-voluntary? Non-voluntary corporate action is an action that is mandatory, compulsory. So this means shareholder has no choice regarding that action. So in non-voluntary corporate action is an action that is mandatory. So this means shareholder has no choice regarding that action. Now let's look at a few corporate actions. First is dividend. So dividend is share of a profit that company pays out to its shareholders. So dividend is a distribution of company's earning to eligible shareholders, and that dividend payments and the amount that determined by the company's board of directors. So these payments are made to shareholders from the company's profit, typically in cash or additional shares. Next type of corporate action is stock split. So in the stock split, company divides its existing shares into multiple new shares, so effectively lowering the price per share while keeping the overall market capitalization same. So this can make shares more accessible to the investor. Next type is mergers and acquisitions. So these strategic decisions made by the companies to consolidate or expand their operations. So they can lead to significant change in the share value and the corporate structure. Next is right issue. So in the right issue, companies offer existing shareholders the right to purchase additional shares at a discounted price. So this often used to raise a capital. And the last type is share buybacks. So companies may buy back their own shares from market, so that reducing the number of outstanding shares. So this can signal the confidence in the company's future and improve earnings per share. So in the conclusion, corporate actions are vital events that can significantly impact both companies and shareholders. So in our next session, we will deep dive into specifics of each type of corporate actions, focusing on their process, implications, and how to analyze them effectively. So thank you for joining and watching this video. I hope